Hey there, I am John Stevenson. Welcome to the show. Today we're going to be talking about how to choose the correct annuity if you plan on retiring early. So what is early retirement? Well, most people who reach out to me who want to retire early are wanting and they're thinking of early retirement as anything before age 59 and a half. So maybe early retirement to you is 62, and I still think that's early as well. But a lot of times when people leave their jobs, maybe they have a pension and they want to retire in their 50s. And they're thinking, man, I would love to be able to purchase an annuity for lifetime income and be able to not be penalized for it. Okay, so there are certain annuities that will penalize you. Well, the annuities don't penalize you, but the IRS will. And so we're going to talk about those. I'm going to share my screen. I'll show you what's available for those, and I'll show you what's available for the ones that you don't get penalized by the IRS. You just have to follow the rules. So anyways, I hope this helps. I have a lot of people that want to retire early, and they kind of look at different strategies. You can use the 55 rule with 401ks as well. That is an option. You just have to keep your money there. It has to stay with the employer. So if it's a TSP or a 401k or 403b, and you want to draw money out for your retirement early and not be hit with that tax penalty, then it has to stay in that retirement plan with them. You can't take it out and put it into an annuity somewhere else. So a lot of times what people do is they will take some, they'll supplement their income needs during their early retirement years from those accounts, and they'll purchase an annuity that will start income later, maybe 5-6 years after that. So they don't have to completely deplete their 401k. So that is a strategy. I'll show you. I'm going to run through a few things here on my screen, but I wanted you to see just kind of what's available to you. If you are thinking about purchasing an annuity and you want to check out what the rates are right now, go to johnstevenson.com. You'll see my calculators. I always recommend people go to the income rider if they're looking for highest income and they want the most flexible terms as far as turning on income at different times. So there are all the other calculators are there as well, SPIAs, DIAs, QLACs, MIGAs if you're looking for fixed rates. But primarily we're going to be focusing on the income rider because that is what gives you the highest annual. All right, so looking at my screen, I'm looking at a client who's 62. They got $1 million. I know this is kind of high for some of you, but I just want you to see what $1 million will pay right now. And some of these are inflated numbers, which means they give you accelerated income in the beginning and they lower it later on. So just keep that in mind when you look at my calculators. It will show those because there is no filter. And then, of course, going down here, you can see the ones that don't reduce. It looks like you get around $73,000 that never reduce. So that's always good when you're looking for just guaranteed income that never goes down. Now, we talked about retiring early, and so you might be thinking, well, maybe I want to retire at 55. Okay, so let's go in. I'm going to edit this, and I'm going to say we want 55 years old, and you know what? Maybe we just got $500,000, okay? $500,000, and you might have, $1 million, $2 million, and you want to just put a portion of it into an annuity that will give you your base, give you your income that you need, and then let the other money ride in the market or other investments, which is always a great strategy, in my opinion, if you just, if you want the best of both worlds. You want some growth from the market, and you also want the guarantees. Okay, so I'm going to pull this up here, and let's look at the income rider, and I'm going to say we're going to buy an income rider and start income immediately. Now, this is going to trigger a 10% tax penalty. Okay, if you don't want this tax penalty, don't buy this option. I'll show you the other option after this. Okay, so $500,000, age 55. Let me get the accelerated options out of there. Okay, so $33,000. Now, you could do the math. Your penalty is going to be around $3,000. So basically $30,000 or $2,500 a month is what you're going to have after the tax penalty, which, might be worth it for you. I mean, yeah, you've got to pay the penalty, but it's only for what, 4.5 years? Okay, until you hit 59.5. And then after that, you don't have to pay the penalty. So think of it as a surcharge for retiring early. That might be worth it to you, but we'll look at a SPIA option and see if that works better. Typically what I tell people in this situation is if you have more money in like a 401k, or a TSP, or something that is still with your employer, then it might make sense to purchase an annuity to take income later, maybe after 59.5. So let me show you. So if we push this out 5 years, okay? 5 years, we got $51,000. That's great. $51,000 a year. And by the way, this is based off of a male who is single. If it's joint, it'll be a little bit less, just depending on the spouse's age. Okay. So we go here, we'll say, all right, $51,000. That's pretty good. Absolutely very good. I mean, if I take that out for 30 years, I'm going to take out a chunk of change, like $1.5 million. I'm literally buying a $1.5 million pension. But at the same time, I want to retire early. Okay. I'm retired at 55 and, maybe I need $60,000 a year. Okay. I'd like to have $60,000 a year to live. And so what I'll do is I'll take $60,000 a year for 5 years out of my 401k. Maybe my 401k has $1 million in it. Okay. I might take $600,000 over that time and live off of it. I'm not going to get penalized by the IRS. Okay. But I will pay regular taxes on it, just like usual. And then I might take this $500,000 from another qualified account, or even just from a brokerage or from cash, and purchase this contract to start income at age 60. And then, of course, I can take income from this, and it's guaranteed for life. And I don't have to worry about depleting my other qualified account, my other 401k. So that is one strategy to use. And of course, if you defer this out longer, you might be working part-time. Maybe you don't need as much income from your 401k. And so you can just supplement a little bit from withdrawals from that account when you're 55. And maybe you want to push this, this out to Social Security age. Maybe you're planning on taking Social Security at 62 and you want the annuity contract to grow for 7 years instead of 5. Well, if you look at that, it's just more. So it's $62,000 a year. So that might be perfect. You're like, all right, I'm going to get $5,000 a month, and I'm going to have that for the rest of my life. And I'm going to have my Social Security payout, which, maybe it's $2,000 a month. So now you got $24,000. So yeah, that's pretty good income. Now you're looking at $86,000 a year from the annuity contract and from Social Security. And a lot of people would argue that 62 is still an early age to retire. And so you could, if you wanted to, just take money from an IRA at 55, maybe from an old 401k, purchase an annuity, keep working till 62, and then activate the annuity and the Social Security right at the same time, replace your income, and then you've got guaranteed income for the rest of your life. And of course, you have your other assets growing in the market or whatever investment that you might have, and then you can strip off the interest from that if you want every 5 to 10 years and just purchase additional contracts for $100,000 or $200,000. Just keep giving yourself raises. That's a great way to maximize your income and growth all at the same time. All right. So if you don't want to pay the tax penalty and you want immediate income and you don't want to take it out of a 401k, you don't want to, you want to take it somewhere else. Maybe you're funding it from a 401k and you could still put it into a SPIA. Okay. It'll still roll over to an IRA, and that'll have the SPIA. A SPIA is a single premium immediate annuity. Okay, so let's take a look at that. So we'll look at, now again, $33,000 is what we were getting for immediate income from an income rider. Okay, but really the net was $30,000, so $2,500 a month. So that's what we're going to compare it to. So we're going to go here and we will look at the SPIA calculator. Okay, cash refund if something happens to us. And then we're going to take income immediately. Okay, so in this instance, New York Life is paying $2,752 per month. Okay, if you're looking for highest income, guaranteed income for life, then this is the best option. Okay, you can see right here, New York Life is paying $250 more per month. And I mean, it's virtually the same as the income rider as far as what it's paying you. But the difference is you're not being penalized. Okay, so you're getting that extra $3,000 a year back. Okay, and the reason why this works is because when you look up the rules, the 72T rule, where they talk about, the IRS says you need to have equal periodic payments. Okay, it's got to be guaranteed for, it's got to be based off of your life expectancy for the rest of your life. And so typically they look at SPIA contracts or DIA. DIA is the same thing. DIA is a deferred income annuity. It's the same type of contract, it's deferred out. I think my personal opinion, the reason why they won't penalize this type of contract is because it's fully annuitized. Okay, so you give the money to the insurance company. There is no cash value. You have guaranteed periodic payments based off of your life expectancy. And of course, you are taxed because it's coming out of that IRA bucket. That's normal. And you can see the monthly taxable right here. It's $2,752. So it's taxed as ordinary income. But because you put it into an annuitized contract that has no more cash value and is based off your life expectancy, I know it sounds very similar to the income rider, and it is. The income rider gives you guaranteed income as well, and they also base it off your life expectancy. The difference between the two is this one has no cash value. Okay, the income rider does. So if you want to cancel it, you can. You'll get hit with a surrender charge, but at least you can still take your money out if you want to. So it's just they look at it a little differently. So you still have to check with your accountant. I'm not a tax advisor, but I can tell you this is what my clients are doing right now who want to retire early and want to avoid this tax penalty. A lot of times what they'll do is they'll buy a SPIA or a couple of them, and they'll take income immediately, and then they'll buy income riders at the same time because they know they can get more income from those versus a SPIA or a DIA, and then they will defer those out another maybe 3, 4, 5 years or longer and plan on taking income from those later, especially when they pass the 59.5 age. One more thing to think about is it does not matter if this is a 401k, an IRA, TSP, it does not matter. It does not matter if it's cash, okay? A lot of people get confused with this because they're like, well, if it's non-qualified funds, it's not in an IRA, therefore it's not subject to the tax penalty of 59.5. Correct, it is not, unless you put it in a tax-deferred vehicle that gives you the same benefits as an IRA. And annuities give you those same benefits. So that's what you have to think about when you're using non-qualified funds. That's what's great about them as well, though. You can put non-qualified funds into an annuity, have it grow tax-deferred, and you can't do that with like a CD. CD, you have to pay taxes every single year on the gains. So that is nice. So there are pros and cons to doing it. It just has to be set up a certain way in a certain contract if you want to avoid that tax penalty. So regardless if it's an IRA, 401k, or non-qualified money, the only way to get away from that tax penalty from the IRS is to put it in a SPIA, okay? But I just wanted you to see the options, okay? You've got the option with the SPIA, right? And you have the option with maybe taking money out of your 401k or whatever employer-sponsored plan it is, at age 55, and you can take advantage of that rule and not pay the tax penalty, just keep that money in that account, and then maybe purchase an annuity with funds planning to take income from that annuity 5, 6, 7, 8 years or longer from it once you get out of that tax penalty phase. So hope this helps. Just trying to share this. There's so many people that reach out to me that ask this particular question, and it's just important to know how it works. So if you want to take a look at annuities and you want to see what's available, go to my website, johnstevenson.com, check out the calculators. You'll see what's available, and then reach out to me. After you've kind of done your research and you feel comfortable, then reach out to me. I'd love to help you purchase an annuity if that's what you're looking for. So anyways, I love to show everything that's available. Commissions are all over the place on these. Some pay high, some pay low, but I like to show everything that's available so you can make the choice on your own before having someone like me try to pitch you. Okay, I hate being sold, and I just don't like it. So I want to make sure that you are at least being able to see all of the information and have it at your fingertips before you reach out and schedule a call. So it's a little bit easier. You don't feel like you're going to be sold something. So anyways, I really appreciate you for listening and for watching. I hope you like the channel. If you do, make sure you click the like button, subscribe, share, comment below if you have questions. I'm happy to help. There is a link below the video too. If you want to book a call there, you're absolutely welcome to do that. And thank you so much for watching, and we'll see you next time.